Good morning, everyone. Thanks for your interest being here. My name's Kamil Dimmich. I'm based in London. I work for North of South Capital. We run about $1.2 billion in global emerging markets. So we're a global emerging markets equity boutique. I'm the wrong height for this. Try this. Great. Try and remember that. Shout at me if you can't hear me. So just really briefly on our background, we're all veterans. We've all been doing this for a very long time. We're a team of 6 people. As I said, we're specialized in global emerging markets. The main strategy we run is a value strategy, so I think quite appropriate for here. It's quite a diversified strategy that looks across both the large cap and the kind of smaller cap universe. So the fund is called an all cap fund. And of course, the most fun part of it is looking for smaller cap ideas, names that are below the radar screen. As value investors, we do tend to be somewhat contrarian. We have an approach that uses the cost of capital and looks at long-term valuations of businesses, trying to really ignore short-term fluctuations. We don't spend a lot of time thinking about near-term quarterly results. It's really about the value that's embedded in the business over the long term, the ability of that business to survive even through difficult times. And so we've got a few slides on process, which I think I'll skip through, but basically we try and differentiate high quality businesses that have that survivability, that have good management, that have good products, that have a good competitive position from businesses that are potentially going to fail when the down cycle hits. And we use the concept of the cost of capital to do that. So we look at the countries that they're based in. Because we're dealing with emerging markets, we have very, very different macro fundamentals for some of our markets. We have different political risks, and those need to be taken into account in the cost of capital, as well as the stock-specific fundamentals. So without further ado, I've picked a stock here for you today. You know, we get asked a lot, what are your best ideas? And I know you guys want to hear the best ideas, but the way we think about investing is we love all our children equally. We have a lot of good ideas. As value investors, we've learned that we have to be very patient. We have to think through the cycle. We don't necessarily have stocks that we think are going to do incredibly well in the next week or in the next month. We have a portfolio of stocks where we feel that they all have the potential to do well over time, where that embedded value is in there, and we think we have the time and the patience to realize that value. So the example I want to give you today is maybe a little controversial, maybe not the stock that everyone kind of thinks is exciting, but hopefully you'll agree with me that it is a really interesting deep value situation. So this is a company, you can see, I'll get into the details in a minute, but the headline is, this is a company that's generated a lot of free cash flow over the past decade. You can see it's generated positive free cash flow every single year, apart from slightly negative in 2014. It has distributed dividends every year, apart from 2022, which was, of course, the pandemic, although it generated a lot of cash flow. It is a company that operates in China. It's listed in Hong Kong. The market cap is about 700 million, so it is a smaller cap company. And very importantly to us, it is the subsidiary of a Taiwanese company. We think a lot about corporate governance and quality of management. Taiwanese companies generally tend to be very well managed. And when we have companies that operate in China, it's typically a major plus if the management is Taiwanese. They really think in terms of total shareholder returns. They think in terms of sharing the cash flow with shareholders. Taiwanese companies pay high dividends, and they certainly bring that approach to the companies they may be running that operate in China. So as you can see, this looks like a pretty good track record of cash generation. We love cash generation. But the company is called Asia Cement. So it is a cement producer in China. Now, we're in Spain here. I guess everyone still remembers the days when Spain was one of the countries that had the highest consumption of cement per capita in the world. We all know how that ended. That wasn't very good. We know China is another country that has been consuming enormous amounts of cement, that obviously has huge cement capacities in place, and where we have a major issue with over-construction, over-investment, and that's something that has started unraveling last year, arguably even before that. The interesting thing is, though, when you look at this chart, this is cement production in China, and you can see actually that really stopped growing about 10 years ago. There's good reasons for that. The Chinese government has clamped down on additional cement capacity. This is partly to do with environmental reasons. Cement is, of course, a highly CO2 emitting process. You have to put coal, burn coal directly in the cement furnace. But also the nature of the Chinese cement industry, as actually many other industries in China, has been there have been a number of large, fairly efficient companies that have been working to consolidate the market, and an incredibly long tail of small regional companies, oftentimes owned by local state governments, that were there to employ people and to simply have an industry that was doing something, many of them loss-making, many of them subsidized. And the focus has been to consolidate, as with many other industries, to consolidate this, to cut out this tail of companies that were often operating below minimum environmental standards, and remove this kind of excess, undisciplined capacity from the market. And that's been a process that's been going on for a decade. So the actual cement market, when you look at it, has been increasingly dominated by larger players that are more efficient, that are, I wouldn't say environmentally friendly, but that are certainly operating within the law and are following rules and trying to upgrade. And you've lost a lot of this kind of very undisciplined capacity. So as a result, despite the fact that you might think this is an industry that suffers from huge overcapacity and where potentially we have this kind of imminent collapse, we have seen that cement prices in China have been pretty stable. We had a weak period in 2014, 2015, if you remember. 2014 was the 1 year where the company generated slightly negative free cash flow. But generally, the industry has been quite disciplined. So you cannot add new capacity. There's no new entrants. You have a consolidation of the industry, and nobody's operating at full capacity utilization. There is excess capacity in the market. But the market is disciplined, so the key large players manage prices, and as you can see, these have been fairly stable. There was a major spike during the COVID period, as with everything else. We had, of course, we had supply disruptions, but generally prices have remained stable. And as you can see, even over the last year, when we have had a collapse in the property market, which was deliberately engineered by the government, we've had a massive reduction in new construction of buildings. We had a pretty weak year in terms of infrastructure investment. We had certainly, well, actually, during the whole year, we had major cities completely shut down for weeks and months due to COVID. And nonetheless, cement prices remained reasonably stable. Additionally, you also had a spike in coal prices last year. China was also affected by the energy crisis. Coal is a major input cost, so margins were compressed. But nonetheless, the cement industry somehow made it through and still made a bit of money. It was probably as bad a year as you could imagine for the cement industry. This company, Asia Cement, actually still managed to generate some positive free cash flow, much less than in previous years, absolutely no question, but it has still generated positive free cash flow and has declared a dividend. Now, I've said all this, and you're probably all thinking, I don't know, this isn't really a great business, is it? I mean, and I have to agree with you. Would I go out and build a cement factory? I wouldn't be allowed to, actually, but would I go and build a cement factory in China today? Probably not. Are those cement factories that are there already Worth something? Probably yes. Well, let's look at the share price. If we look at the balance sheet of this company, the company has no debt. It has built up cash, although it's been paying quite generous dividends. It has built up a lot of cash over the years because we've had very high cement prices and it's been very profitable. One interesting point here is the depreciation charge of the company is double its capital expenditure. So if we think about free cash flow generation, even when the company reports a break-even EPS, it's still generating significant cash flow because all the assets are already there. There is no growth, there is no expansion. They're just producing the cement. Depreciation is a non-cash cost, and that cash flow is coming through. So we've built up, what we can see here is 7.3 billion Hong Kong dollars. I'm translating into Hong Kong dollars because that's where the stock is listed in Hong Kong. $7.3 billion of net cash. The entire market cap of the company is $5.4 billion. So forget the cement assets, forget the cement business. You are being paid to own this business. The market cap, the upside, if they were just to return the cash to shareholders, shut everything down, you would have a 30% upside to the current market cap. This is the kind of deep value situation we remember from 2008, when you had forced sellers of everything. You had companies with solid balance sheets that had profitable or traditionally profitable businesses. Maybe they were making a little bit of a loss and that were trading around their net cash values. It's something that's fairly rare. It happens when people take an extremely negative view on a particular market or an industry and nobody cares. And it happens in particular with smaller cap stocks that simply don't have the flows to support the share price. So if we come back to this kind of valuation, the book value of the cement assets, which are of course being written down, they're depreciating, but they're still producing, the capacity for them to produce hasn't been reduced, is another over 10 billion Hong Kong dollars. And there's also actually some positive working capital in the business as well, in terms of some receivables and inventories. So in total, basically, if you add up all the assets of this business, that's about 3 times the market cap of the company. If we look at the future cash flow generation potential of the business, assuming a normalized pricing environment, and again, we're not particularly bullish on the Chinese cement industry, but it is a business that has shown it is capable of maintaining pricing power and maintaining some sort of returns. We get a very similar number to the book value, around 10 billion fair value. So in total, what you've got here is a pretty distressed deep value situation. The company continues paying dividends, so the dividend yield is around 5% based on last year's terrible profits. Not that exciting, but again, you're being paid to own this stock. And it is a stock for the patient. There isn't an exciting catalyst. I don't think anyone is expecting a boom in the Chinese property market to resume, although transactions are picking up, and this year could be a little less bad than last year. But that's not really the driver here. The point is you're getting something for free, and we love that as value investors. The one possible catalyst that you could have, and we, as a matter of course, we speak to the companies we invest in, and we have discussed this with them a number of times. There is a possibility that the parent company, which is a big Taiwanese conglomerate, might decide that having a Hong Kong listing no longer makes sense. It costs money to have a company listed. When the company listed many, many years ago, the idea was this was going to be their flagship growth business in China. Clearly today, that's no longer the case. Having this listing isn't exactly a great showcase for the company. And were they to buy it even at a decent premium to the current share price, it would pay for itself with the cash that's already on the balance sheet. So this is something that is absolutely on their minds. I know that it's something that they will be discussing, they'll be looking at, and it's a really easy way for the parent company to create some value out of absolutely nothing.
How much do they control?
So they own about 60%. So they consolidate the company. So on their balance sheet they already show these assets, but obviously they can't touch the cash. If they have investment ideas they have in Taiwan, they can't really get at the cash unless they pay it out as dividends. But actually a far more efficient way of doing that would be to delist the company. So, you know, this is an ugly stock, no questions. This isn't the kind of company you know, if this wasn't a value conference, I would never talk about this stock. But I think for you guys, maybe this is something interesting. And I think the point is, you know, the way we think about investing is we assemble a collection, a diversified collection of stocks that are just clearly undervalued. We do look for good businesses. We look for good corporate governance. We don't want to buy bad companies or highly leveraged companies that are going to go bust because the cycle has turned. And if we're able to be patient with a collection of these kind of ideas, every now and then some of them will come good and they become 2 baggers or 3 baggers or 4 baggers. And that overall gives you a certain stability of returns and an upside that you can capture over time. So, you know, we've sort of, our strategy is meant to deliver between 3 and 5% outperformance against the index over the cycle. We've been doing this for 12 years. We've delivered 4% annual outperformance. We've outperformed every year out of the last 7 years. And it's really thanks to having a nice variation of small ideas that are quite clearly undervalued, may be completely out of favor, may not be on people's radar screens, but that's what value investing is about. Thank you.
Any question?
Have they talked about whether they'll do like a tender offer for the cash? And does the actual parent co need the cash, or is it one of those kind of sleepy companies that's kind of happy to leave it as it is? You know, is there any sort of catalyst for returning the money back to shareholders, a tender offer, a special, or something like that?
So, at the moment, the company, well, the parent company is Taiwanese. Taiwanese companies have very conservative balance sheets. And so they don't need the money. There isn't an urgent need for them to touch the money. And that's why it's just been sitting there. What they have been doing is they've been quite consistent in paying fairly decent dividends over time. And that again is a very Taiwanese thing. And what gives us comfort, if the company had never paid dividends and that cash was never touched, potentially used for some crazy M&A, we would be a lot less enthusiastic about the idea. But yeah, so the truth is they don't particularly need the money, but we've raised, so we talked to management, we've raised this idea with them, and it is something that is clearly on their minds. They can see there's an obvious, easy sort of value creation. And I think if the company does find uses for the cash at parent company level for international expansion, I think there's a very good chance they might do this and might make a tender offer.
Are they incentivized to pay the cash out, though, the guys at the actual sort of subsidiary co?
So, no, so there isn't a formal, I'm pretty sure there isn't a formal link to the dividend payout with management incentives. So it's ultimately something that's going to be decided at the parent company.
Is the parent company quoted?
Yes. Parent company is quoted, so it's quite transparent. It's a conglomerate. They have a number of businesses in China, in Taiwan, and elsewhere. Partly cement, partly other businesses. I think there's some shipping businesses in there as well. But it's also, yeah, it's a transparent company. It's a well-known Taiwanese company.
Do you have a stock chart?
Actually, I don't. No, I didn't put a stock price, but it's the ticker. The ticker is what did we say? Very good, 743. The stock price doesn't look great. It's been declining over last year. Unsurprisingly, anything to do with cement construction has been declining, and that's what's led to this kind of undervaluation. Please.
I looked up the stock chart. It's down 51%. Looking up the stock chart, it's gone
Yep.
down 51% since it went public in '08. I guess, have you guys asked the question, is this conglomerate a very good partner?
Is this conglomerate a very good partner? Well, you're looking at the China cement, the 743.
Correct. Yeah.
Yeah.
It's on Bloomberg, I believe.
Yeah, yeah, absolutely. So this is a deep value situation where essentially you've had a company that's been in a sector that's been hugely out of favor. When it was listed, that was a very exciting sector to be in because China was growing at 10% per annum, and cement, well, as you've seen in the track record, it has generated a lot of cash flow over time. The sector is now completely out of favor. There is zero interest in a small cap cement company in China, and so that's why it's gone down. So, is it a good partner? It's kind of neutral. It's the management haven't made any big mistakes. They're in a sector that is completely out of favor, and that's why the share price has gone down. I can hear you, but
Okay. Two questions. You spoke about the listing. What about buybacks? Are they doing anything around that? Are they considering that? That's probably an easier way to do it.
the challenge for them with doing buybacks, we've discussed this as well, is the relatively limited liquidity and free float. When you do buybacks, and this is often the case we find with smaller cap companies where the valuation is crazy, they might be limited by minimum free float requirements by the stock exchange, but more importantly, as you retire shares from the stock exchange, the liquidity gets less and less and less and becomes less investable for larger institutions. So in a sense, for a company like this, it makes more sense to just delist rather than do buybacks and become less and less liquid and have a pretty pointless listing where nobody can actually trade it. So this is, yes, the first thought is always, why don't you do a buyback? You've got this cash, you can buy your shares at a discount to the cash you have. But the implication of it is your share becomes completely untradeable.
Yeah, you're right.
25% free float rule in Hong Kong, and they own 73. So
It's 70, yeah, so they're very close to that, yeah.
Second question, what do you consider is the biggest risk for the company, not for the stock, for the company in terms of their business going forward?
Well, there is a negative scenario. In fact, you can draw a lot of negative scenarios for China, and in a sense, that's where the opportunity is, because of course, China is a risky market. The big risk is that you continue having pressure on cement demand. So the property market does not recover at all, and the country continues reducing its consumption of cement, and at some point that pricing discipline breaks. So if your capacity isn't being reduced in parallel with falling demand, like any other commodity sector, there is a point where it could lead to a price war and a breakdown in discipline. In fact, last year we have had one of the players, Anhui Conch, which is one of the biggest cement players, start a mini price war in some of the regions. So they started being more aggressive in pricing and drove down the price for a while, trying to get market share. It didn't go anywhere. Everyone followed suit, nobody gained market share, everyone lost a bit of money, and they reverted back to quite disciplined pricing. So, but the risk, absolutely, there is a risk you get an aggressive market share war with aggressive pricing. The negative aspect of having very low capex and high depreciation is you can actually afford to produce at a loss, certainly from an earnings perspective, because you'll still generate some cash flow, even though you're technically losing money because you're not covering your cost of capital. So the risk is, really the big risk is a complete breakdown of pricing discipline. But we haven't seen that so far. We haven't seen it last year, despite some attempts. And I think, you know, that gives me some confidence that some sort of returns are probably sustainable from this business.
One second.
The stock price seems to be quite correlated with cement prices. That's my first question. The second one is China, during the last 3 years, during that period, it produced 50% more cement than what the US produced during the whole 20th century. So there's a huge capacity there. Plus, there's a huge real estate bubble in China with tons of overcapacity. So what's your view on cement price?
So, well, the correlation with cement price, there clearly is some, and that's why the stock is cheap, because cement prices have declined from higher levels, but remain reasonably stable. But I think what's my view on cement price? I don't particularly like cement in China. What you've said is exactly correct. China produces huge amounts of cement. On a per capita basis, it's probably the highest in the world. And as I said, in Spain, we had a similar situation back in 07, 08, and that all ended badly. This isn't about the cement price. This is about the fact that you get paid to own a business, you get the cash balance at a discount, and everything else is for free. And my central view would be that although cement prices are not going to go up to particularly high levels, as long as that business can cover its operating costs and generate even a marginally small positive free cash flow, you're not eating into that cash pile that they've built up over time, and that cash pile is valuable. And so I don't really care that much about cement prices is the answer.
Anybody else? One second, John.
In terms of mopping up the minorities, I mean, there's a lot of these take-unders, not takeovers in Hong Kong. I mean, have you spoken to them what they need to offer? Is there anybody with a 10% blocking stake? I looked at the share register, it doesn't look like it. I mean, they could easily basically bid for the company at a tiny premium, even below the cash, and just, who's going to stop them in terms of doing that? I mean, why haven't they done that yet?
Well, so I think this is where we go back to the fact we've got a Taiwanese company with Taiwanese management that have shareholders of their own and care about the valuation of their own stock. And I think doing something like that technically could be possible, would reflect very badly on management, because they're essentially screwing minority shareholders in one of their businesses. So this goes back to this governance idea, and this idea that we think realistically they would have to offer some sort of premium. They can offer a premium while still making it very, very attractive for themselves. So you have to make a judgment on management's likely motivations here, and I think the risk for them of being perceived in the main company as people who mistreat minority shareholders is a lot higher than what they would have to gain by actually probably saving a very small amount of money in relative terms in bidding for this small outstanding free float.
Okay. So, thank you very much.
Thank you.